much faith should we put into yesterday's rebound and this morning's blast-off rally? Yeah, the one that petered out this afternoon. In turbulent times, and this is about as turbulent as it gets, I find it's always a good idea to take your emotions out of the equation. Being emotional clouds your judgment, whether we're talking about panic or euphoria. That's why we need to take a more quantitative approach, focusing on the technicals as we do on Tuesdays. So tonight we're going off the charts with the help of Mark Sebastian. Oh, he's a brilliant technician who's the founder of OptionPit.com, as well as being my colleague at RealMoney.com. And he's our resident volatility expert, the guy I always go to. So I get a clear read of this roller coaster of a market and maybe when it'll end. All right, throughout this pandemic, the CBOE Volatility Index, or the VIX for short, has been a very useful reality check. Normally, the VIX and the stock market move in opposite directions. When the market goes up, the VIX goes down, and vice versa. There's a reason it's commonly known as the fear gauge. But when that normal pattern breaks down, it can tell you something very important about where stocks might be headed. So let's go right to it. First, take a look at these daily charts of the S&P 500 and the Volatility Index, all right? So Sebastian points out that right before the market peaked, that's the S&P, in February, the VIX was actually working its way higher along with the S&P. See, that's a dead giveaway that something was awry. Chart 2 tells you more. This is a zoom in on the S&P 500 and the VIX just since the beginning of March. Last week, the market was extremely choppy, and we ultimately finished in the red, okay? However, during the period the S&P got hit, the VIX went straight down. Remember, in normal decline, the volatility index should go up. For Sebastian, the VIX performance last week confirmed that we already reached peak volatility of this move, and therefore the fear is subsiding. Most of the time when the VIX moves in tandem with the S&P, it's a sign the trend could be about to reverse itself. So when they're both going down at the same time, Sebastian thinks that's usually a great buy signal. Sure enough, we came in this week and got an amazing move higher. It's like a mini bull market in one session. Well, actually, 1.5 sessions. It's just what you expect based on his methodology. However, these are not normal times. Sebastian thinks it pays to be cautious after yesterday's monster run and today's reversal. Why? All right, because, again, the VIX is supposed to go down when the market goes up. Yet the volatility was down a lot more last week when the S&P was getting hammered than over the past couple of days where the S&P has surged more than 8%. Uh-oh. Last week, a bad week for the stock market. The VIX fell from 65 to 46. The fear was way, way down. Yesterday, a great day for the stock market. It went from 46 to 45. Today, even when the averages were going strong, the VIX never went below 43. That was a sign that the move might prove to be ephemeral, and it was. Here's the problem for Sebastian. It was a good sign when the VIX nosedived along with the S&P 500 last week. It meant the decline in stocks might be temporary. But by the same token, it's worrisome when the market explodes higher and the VIX does next to nothing. Because, well, let's use some history here. What does this action mean? The closest analog for this market is the financial crisis in 2008 and 2009. And a lot of people talk about them as the same. Remember, that was the Great Recession. Take a look at what happened to the S&P 500 and the volatility index back then. And by the way, we don't really want a lot of similarities because that was a terrible time. In 2008, we had a longer and deeper sell-off than we've had in 2020. But it's also a lot slower. However, Sebastian sees some similarities. This was the only other time where the VIX surged above 80. Can you imagine 80? That was something when this happened. And crucially, volatility peaked in mid-November, months before the market actually bottomed. From the volatility peak through the end of 2008, the VIX moved steadily lower, while the S&P 500 made a nice pop. And then spent 2 months churning sideways. So that was, like, okay there. Back then, the fear had peaked. We processed the panic from Lehman going under. The banks were being bailed out. But we still had no idea how long the crisis would be and when it would end. Sebastian points out that we're seeing a very similar pattern right now. Back then, as we gradually realized the extent of the carnage and the S&P moved lower again, this time more slowly, without a big spike in the VIX. We had already braced ourselves for more weakness, so the winter 2009 meltdown didn't freak people out the way the fall 2008 meltdown did. So you can see the VIX kind of didn't react. As Sebastian says it, we're going through the same thing right now, only faster. He thinks we're now in the December to January time frame. Okay, so if we want to go to December to January time frame, then we know that we're looking at a pretty decent time. Okay, we're going to get up there. We're going to start going up. But remember, this was down. I'm sorry, we're headed into. I don't want to say this was good. This was horrible. This was the fabled bottom, all right? That's where the market's no longer scared, but also not yet ready to sustain a rally. If the financial crisis is any guide, Sebastian's expecting choppy action for the next months. And by the way, choppy action is not good, okay? Choppy action for the next months as we start to see more hard data about the economy, the layoffs, the bankruptcies. He thinks we're going to get hit again. That's my thesis, people. That's exactly my thesis, as I said at the top of the show. But, and this is a big but, if the VIX doesn't spike the next time the market rolls over, Sebastian recommends doing some buying in the weakness. In other words, there's no need to chase stocks after this week's rally. Amen. You can afford to be patient and buy the dips. And we saw a lot of dips in this period, too. Oh, and you're investing for the long haul, you may get some much better entry points than today. No need to feel any FOMO here. I couldn't agree more. Remember, we could be here, all right? Because the VIX is steady. And at any given time, you're going to get a little blip up. And that was a fake out. This was a fake out. Get me? These were all fake outs. I don't want you to buy a fake out. I want you to get right here, or at least as close. Whatever. The bottom line, the charts as interpreted by Mark Sebastian. I almost put my fist through that. Did you know that? But because I'm Jimmy Chill, I didn't do that. The old Jim Cramer would have put his fist right through that. And then I would have just gone and gotten stitches. Anyway, the charts suggested by Mark Sebastian, the big fear, total collapse of the economy and the stock market, I think has been taken off the table. That's what he says. But that doesn't mean we're ready to roar. Instead, he's expecting a choppy market that may give you another leg down as the ugly economic data keeps rolling in. I think he's got to seeing it. And think about all the stitches I would have had and would have been for naught. It would have been for naught. That's why I'm Jimmy Chill. Kevin in New Jersey. Kevin.
Hey, Jim, how are you? Booyah.
Booyah.
How's it going?
What, really? I got a great team. Let's put it that way. But it's not time to talk about how lonely I am, is it? No, keep going. Let's go. What's up?
So Goldman Sachs recently announced the sale of Beyond Meat. Do you think there's well enough diverse between supermarkets and restaurants to weather the storm?
I do, Kevin. I really think that people who hate this stock do not understand that it's more than just whether it's a food service company or sold at the supermarkets. It's an ethos. I keep trying to tell people it's an ethos, and they're going to be around for a long time, and Ethan Brown's terrific, and a lot of people are short it, and I don't think it's a great short because short-term short can go down, just the way Tesla did. Longer-term Beyond Meat is for real, and I think people should stop knocking it. I'm not saying – if someone says – that Jim just said buy it. That person is someone who did not listen to the capsule, not the whole thing, where I said it could go down, but I like it. Let's go to Eli in Illinois. Eli.
How's it going, Jim?
Pretty good. How about you?
Good, thank you. So my question is about Energy Transfer, which I own a small position in. And it seems to me that Energy Transfer is in a good position to outlast the pandemic, but will it maintain its positive free cash flow? And what especially shocked me was the incredibly high dividend that they offer at a current yield of 22.3.
I said that dividend this morning. I didn't trust it. This guy, Kelsey Warren, he'll buy anything that moves. This thing is at the epicenter, along with Chesapeake, of what could happen to the oil group. Look, it's too late now, but there's a bad stock. There, I said it. And by the way, the master limited partnerships,
the house of pain.
The chart suggests we don't want to have a total collapse of the economy. That doesn't mean we're ready to just roar in the stock market yet. We're probably somewhere around here. There's much more we have money ahead. More and more organizations roll out remote working initiatives. Many businesses are struggling with issues around slow home networks. I'm eyeing a private company that can explain why your PC is so slow at home when you're working. Then, what stands out in this market? An appetite for risky debt. That's what stands out. I'll tell you what's driving it. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.